Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Wednesday, May 6th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. The S&P 500 was down 0.7% today, and we closed at 2848.42. The first chart that we're looking at is an intraday chart of the S&P 500, where each candlestick represents 1 minute of trading. What we can see here is we gapped up at the open, started to sell off, and then got down to this unchanged line, this dotted blue line, where we kind of traded above and below that area for the majority of the day. Around 3:30 in the afternoon, we sold off and closed at the lows of the session. The only two sectors that were positive for the day were the technology and consumer discretionary sectors. The technology sector was up 0.89%, and the consumer discretionary sector was positive 13 basis points. The worst performing sector for the day was the utility sector, which is down 3.48%. What we're looking at here is a year-to-date chart of the S&P 500 where each candlestick represents 1 day of trading, and I've overlaid the Fibonacci retracement levels on top of this chart. And of course, we can see here over to the right where we closed today, closing just beneath this 2850 level. And we've been trading for the last several weeks between the 50% and 61.8% retracement levels of this entire move that we've had so far. And so kind of the key levels to watch, and I'm just going to round these numbers, would be 27.93 and 29.35. And as you can see, the majority of our trading for the last couple of weeks has been in between those levels. So as long as we stay in between those levels, we are in pretty good shape. But if we start to close beneath this 50% retracement level, which again is at 27.93, so let's just call it 2800 for easy math. If we start to close below 2800, then we know that the market is starting to weaken. But as long as we continue to trade in this area, basically what it means is the market is going sideways. But as I've been pointing out for many days now, this has been a very weak, very thin rally where the majority of the strength has been in the technology sector. And I just don't think that the tech sector, as well as some healthcare, is going to be enough to continue to support this market in an upward trajectory. We're going to need to see the breadth widen out. We're going to need to see participation from small caps and mid caps, and it would be great to see the international stocks start to perform better as well. So as I've been saying, be careful if you are long this market, and don't be overly confident that we're going to continue to go higher from here. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. I hope you've enjoyed today's session. Please remember to subscribe to this channel and give me a thumbs up on this video. Also, if you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, 403b, your IRAs, or of course your trading account, I would encourage you to take a serious look at Simple Market Signals, which, as you know, is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about Simple Market Signals, here is some additional information. As part of the Simple Market Signals model, there are two powerful indicators. There's a risk-based indicator and a trend indicator. As a subscriber to Simple Market Signals, you will receive information on what the risk level is in the overall stock market, as well as what the trend direction is in the overall stock market. So this really, really helps. The way we disseminate the signals to our subscribers is via our weekly emailed newsletter. So within the newsletter, every weekend, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the early bird indicator, the trend direction signal on the overall U.S. stock market. You will have market and sector performance information on multiple time frames. You'll get market commentary and a weekly recap of what happened in the market. You'll have technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information in this newsletter every weekend. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and your first 2 weeks are free. Now let's recap what you get with your subscription to Simple Market Signals. You get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there is a major signal change or direction change, we're not going to wait until the weekend to get that information to you. We will send out a special midweek update when necessary to keep you up to date as to what's going on within the model. And the best fit for a subscriber for Simple Market Signals is somebody that has at least a 6 to 8 week time frame or longer. So if you're a long-term investor, you're going to love this. If you have at least a 6 to 8 week time frame that you focus on with your trading and investing, you're going to love this. If you're an ultra short-term 1 or 2 day trader, kind of a day trader, or somebody that trades within a week, Simple Market Signals might help you a little bit. But the reality is, the people that are going to benefit the most from a subscription to Simple Market Signals are those people that have at least a 6 to 8 week plus time frame that they're focusing on. And if you want even more information on Simple Market Signals and some of the strategies that you can use on the various signals, this is a very in-depth video that I will have linked in the description box below this video, along with a bunch of other videos that you may want to explore if you need additional information on Simple Market Signals before you subscribe. Also, keep in mind that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. And to subscribe to Simple Market Signals, all you have to do is go out to the website that you see here, https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that simple.